Dot. Introduction. Hello and welcome to this video on the analysis of business transactions. In this video, we will discuss the steps involved in analyzing a business transaction and how it affects the financial statements. Body. Business transactions are the events that occur in the course of business operations that result in a change in the financial position of the company. The analysis of business transactions involves the following steps. Identify the transaction. Identifying the transaction is the first step in analyzing a business transaction. This involves identifying the event or activity that has occurred in the course of business operations that resulted in a change in the financial position of the company. Transactions can be either external or internal. External transactions involve the exchange of goods or services with external parties, such as customers, suppliers, or creditors. Examples of external transactions include sales of goods, purchases of inventory, and loans from banks. Internal transactions, on the other hand, involve events or activities that occur within the company, such as the depreciation of fixed assets or the payment of employee salaries. These transactions do not involve external parties. Once the transaction has been identified, the accounts that are affected by the transaction need to be determined. This involves analyzing the impact of the transaction on the financial position of the company and the corresponding accounts that are affected by the transaction. This leads to the second step in analyzing business transactions, which is determining the type of account affected by the transaction. Determine the type of account. Determining the type of account is a crucial step in the analysis of business transactions as it helps in understanding the impact of the transaction on the financial statements. Accounts can be classified into 5 types: assets, liabilities, equity, revenues, and expenses. Assets. Assets are economic resources owned or controlled by a company that are expected to generate future economic benefits. Examples of assets include cash, accounts receivable, inventory, property, plant and equipment, and investments. Liabilities. Liabilities are obligations that a company owes to external parties, such as suppliers, lenders, or customers. They represent the company's debts and are expected to be settled by providing cash, goods or services. Examples of liabilities include accounts payable, loans, and taxes payable. Equity. Equity represents the residual interest in the assets of a company after deducting its liabilities. It is the ownership interest of the shareholders in the company. Equity includes common stock, retained earnings, and dividends paid. Revenues. Revenues represent the inflow of economic resources resulting from the sale of goods or services. Revenues increase the equity of the company. Examples of revenues include sales revenue, rental income, and service fees. Expenses. Expenses represent the outflow of economic resources incurred in the course of business operations. Expenses decrease the equity of the company. Examples of expenses include salaries, rent, utilities, and interest expense. Understanding the type of account affected by a business transaction is important as it determines how the transaction will be recorded in the financial statements. For example, if a company receives cash for services rendered, the cash account and revenue account will be affected. If a company pays rent for office space, the rent expense account and cash account will be affected. In conclusion, determining the type of account affected by a business transaction is a key step in analyzing the transaction as it helps in understanding the impact of the transaction on the financial statements. By correctly classifying the account, accountants can ensure that the transaction is accurately recorded in the financial statements. Determine the direction and amount of the effect. Determining the direction and amount of the effect is a crucial step in analyzing business transactions in accounting. This step involves analyzing the accounts affected by the transaction to determine whether the account balance is increasing or decreasing and by how much. For example, if a company purchases equipment for $10,000, the direction of the effect will depend on the type of account affected. In this case, the equipment account will increase by $10,000, indicating that the company has acquired a new asset. The cash account, on the other hand, will decrease by $10,000, indicating that the company has spent cash to acquire the equipment. Similarly, if a company sells goods for $5,000 on credit, the direction of the effect will depend on the type of account affected. The revenue account will increase by $5,000, indicating that the company has earned revenue from the sale of goods. The accounts receivable account will also increase by $5,000, indicating that the company has an asset in the form of a claim to receive payment from the customer. It is important to note that the direction of the effect on the account balance will depend on whether the account is an asset, liability, equity, revenue, or expense account. An increase in an asset account is recorded as a debit, while a decrease is recorded as a credit. The opposite is true for liability, equity, revenue, and expense accounts. An increase in these accounts is recorded as a credit, while a decrease is recorded as a debit. In summary, determining the direction and amount of the effect of a business transaction involves analyzing the accounts affected by the transaction and determining whether the account balance is increasing or decreasing and by how much. This step is crucial in ensuring that the financial statements accurately reflect the company's financial position and performance. Record the transaction. The final step is to record the transaction in the accounting system. This involves creating journal entries to reflect the changes in the affected accounts. These journal entries will then be posted to the general ledger, which will be used to prepare the financial statements. The analysis of business transactions is important because it provides information about the financial position and performance of the company. It also enables the company to make informed decisions about future operations and investments. Conclusion. In conclusion, the analysis of business transactions is an essential part of accounting. It involves identifying, determining the type of account, determining the direction and amount of the effect, and recording the transaction. By following these steps, the company is able to accurately reflect its financial position and performance in the financial statements.